He had become a celebrity. There is no question. One of the richest people on the planet, and certainly one of the youngest rich people on the planet.
He was on the cover of Fortune this year being compared to Warren Buffett.
30-year-old billionaire Sam Bankman-Fried, better known as SBF, saw a meteoric rise as crypto's golden boy.
The more time I spent with Sam, the smarter I felt that he was.
My goal is to be able to donate almost everything that I make.
A seemingly altruistic billionaire looking to have a big impact.
I don't give a shit about my legacy. Like, I care about the impact that I have.
He struck me as somebody that was really trying to do something transformative.
Which is why the crypto scandal that engulfed him shocked the world.
News overnight, Sam Bankman-Fried is now in custody in the Bahamas.
His $32 billion cryptocurrency exchange, FTX, goes bankrupt in a matter of days. $8.9 billion in customer funds are missing.
I thought he was the Mark Zuckerberg of crypto. Is he now the Bernie Madoff of crypto?
Top minds on Wall Street, Silicon Valley venture capitalists, A-list celebrities, and millions of crypto traders flocked to FTX, trusting Bankman-Fried with their money.
I lost over $2 million on the FTX platform when it went down.
Now FTX customers who lost millions are sharing their stories.
It's really, really sad. Really sad. Not only how it's affected me, but how it's affected millions of people globally.
Investors who gave FTX tens of millions in capital are speaking out. So you feel betrayed?
Oh, 1,000%. I'm betrayed and disappointed.
And the former president of FTX US, who resigned less than 2 months before its collapse, tells all.
What Sam did was old-fashioned financial fraud.
So far, all anyone has from Bankman-Fried is an apology.
I'm deeply sorry about what happened.
And customers want answers.
I'd never lost that much money in that amount of time before.
This was probably one of the most scariest times, like, ever.
I am definitely pissed at SBF. This was an entrepreneur who could have done really great things.
How did it all go so spectacularly wrong?
I'm not going to revise history. I liked him and trusted him.
How could so many have been fooled?
With an entity like FTX, there were clearly glaring red flags beyond any that I'd ever seen before.
And will his customers ever get their money back?
I'm in quite a big hole right now. I'm probably going to have to file for bankruptcy.
Hi there, welcome back to the channel. Let me ask you this. How likely is it for someone worth billions to lose everything over a single weekend? You'd probably bet on never. Yet that is exactly what happened to Sam Bankman-Fried, who is the CEO of FTX, once the world's second largest crypto exchange. He was everywhere. Magazine covers, high-stakes events, rubbing elbows with the likes of Jeff Bezos, Leonardo DiCaprio, Sia, and Steph Curry. At one point, his net worth was pegged at $26 billion. Investors like BlackRock and SoftBank poured money into his vision. But behind all that glitter, chaos. The empire was really run by a small, tight-knit crew, several of them romantically linked, operating out of the Bahamas. When FTX fell, over 100 related companies collapsed, leaving many people's savings in ruin. This is a story tangled with politics, global conflicts, and echoes of Enron. It has the drama of Theranos and the speed of a Lehman Brothers-style downfall. Welcome to the unraveling of FTX. Sam Bankman-Fried, mop of hair, unassuming demeanor, is our central figure. He was born in 1992 in Stanford, California, to parents deeply embedded in academia. His mother, Barbara Fried, is a lawyer and a former law professor. His father, Joseph Bankman, taught law too. Growing up in that environment, Sam had both privilege and pressure. In 2014, he graduated from MIT and landed a job at Jane Street Capital in New York, where he began experimenting with crypto arbitrage, buying Bitcoin cheaper in one market and selling it higher in another, sometimes shifting tens of millions daily. By 2017, with capital earned from these trades, Sam co-founded Alameda Research, pulling in friends from MIT and Jane Street to build a crypto trading firm. Alameda would later become central to the collapse. Sam espoused effective altruism, the idea of doing as much good as possible with your life. But the reality diverged sharply. As his wealth grew, he cultivated a public persona of humility, driving a modest car, acting low-key, even while owning a multi-million-dollar mansion in the Bahamas. The Humility Act appealed. Influencers bought into it, promoting his companies as the ventures of a benevolent genius. While at Jane Street, Sam met Caroline Ellison. They began dating. She was unsure of her path until Sam suggested she join Alameda. She accepted, though she had little trading background. And soon, she rose. Rapidly.
Okay, the guy you see next to me is the most generous billionaire in the world, and I found him.
Hi, my name is Sam.
By the time the cracks began showing, Caroline Ellison was the CEO of Alameda. Alameda, as Fortune once put it, was run by a gang of kids in the Bahamas. Much of the team came from Sam's circle, former colleagues, MIT grads, housemates in a tight social cluster. Romantic relationships overlapped, friendships tangled, loyalties blurred. Caroline, at one point, publicly discussed hierarchical dynamics in polyamorous relationships, ideas she spotlighted on her social media. I'll leave that part to you to absorb. In 2019, Sam launched FTX, a crypto derivatives exchange.
In less than 2 years, this little office park in the Bahamas becomes home to one of the largest cryptocurrency exchanges in the world, built by traders for traders.
The platform worked. It was probably the best platform out there in terms of user experience.
More than 5 million users flocked to the exchange, according to FTX, and they were trading big money.
Think of an exchange as a marketplace for crypto. You store, trade, borrow, lend tokens, all for fees. FTX offered special perks to users who held its native token, FTT. That token would eventually become the flashpoint of the entire collapse. Behind the scenes, this inner circle kept crucial details from FTX's top executives. As one former employee told Forbes, the group was a little clique, a bunch of degenerate kids at the end of the day. So what did Alameda actually do? In essence, it acted as a hedge fund, making trades, matching buyers and sellers, promising returns.
We have $10–15 billion of daily trading volume on the platform.
From Wall Street to Silicon Valley, some of the smartest money becomes desperate to get in on the action.
And he was an industry leader and a first mover in cryptocurrency exchanges. He had a big vision for the future, and he was minting money.
Investments in FTX pour in, totaling nearly $2 billion.
I think their impression was Sam was the ideal tech founder who had landed on a gold mine. He had this way of making everyone really want him to succeed. He was this person who was incredibly smart. He was ambitious.
He was well pedigreed. He had gone to MIT. His parents were Stanford University professors. He had worked at Jane Street, an organization that everybody on Wall Street respects. And so that combination of things is a pretty interesting thing.
But the way it operated, using hidden leverage, risky bets, and borrowings from FTX, would ultimately be its undoing.
Not long after Alameda got off the ground, an alleged 2019 promotional document started turning heads. It promised investors a 15% annual return with zero risk.
I think what really gave him credibility was the exponential profits he was making for the investors and the billions of dollars he was throwing around like monopoly money.
The co-founder of FTX is spending millions promoting the exchange with high-profile celebrity endorsement deals to bring in more and more customers.
It became an obsession. More sports teams, more sports celebrities, different kinds of properties that we could put our name on.
NFL superstar Tom Brady becomes an investor and is featured in FTX commercials.
FTX is the safest and easiest way to buy and sell crypto.
Comedian Larry David stars in a Super Bowl ad that cost millions.
FTX, it's a safe and easy way to get into crypto.
I don't think so.
A pitch that sounds too good to be true because, well, it was. According to reports later confirmed by the Wall Street Journal, Alameda wasn't just trading with its own capital.
the firm had been quietly using customer deposits from FTX, roughly $10 billion worth, to fund its high-risk bets. In other words, the exchange and the trading firm, both owned by Sam Bankman-Fried, were moving customer money back and forth like it was play cash.
For FTX, the first time I heard about it was on the Super Bowl ads. So I was like, oh my goodness, there's all these big name people utilizing FTX.
All the A-list names associated with FTX gives customers the impression there's been ample due diligence done on the exchange.
Did the celebrities make me feel more comfortable about using FTX? Personally, it did.
But in reality, everyone involved is gambling on the success of FTX and placing their trust in its founder.
Remember, when you're talking about a venture capitalist, you're talking about a risk taker with capital, you're going to go 1 for 10, you're going to go 1 for 15. And in that 1, you may find the Google or the Facebook. And so Sam was one of those 1 for 15 or 1 for 20.
But customers placing their faith in the exchange have much more to lose.
That kind of maneuver would be flat out illegal in traditional finance. Using customer funds for proprietary trading isn't a gray area. It's a felony-level breach of trust. And yet, according to Reuters and the Wall Street Journal, billions flowed from FTX to Alameda, fueling trades that customers never agreed to. To make matters worse, FTX and Alameda weren't separated by corporate firewalls or compliance checks. Just a few steps of sand and palm trees in the Bahamas. Their offices sat in the same co-working complex, practically within shouting distance. So when reporters asked what oversight existed between here and over there, the answer was simple: none. This wasn't Wall Street, this was the Bahamas, and that distinction made all the difference. Meanwhile, Caroline Ellison, Alameda's CEO, wasn't exactly easing investor fears. In one interview, she said, "I use very little math."
Mostly elementary school stuff. Being comfortable with risk is very important. We don't really use stop losses. For anyone managing billions, that sounded more like a dare than a plan.
The implosion of FTX begins in the suburbs of Chicago. Nick Baker, the editor-in-chief at CoinDesk, a crypto news website, is working from home when one of his reporters reaches out with a story.
Ian Allison, our reporter, started hearing Alameda, this trading firm owned by Sam Bankman-Fried, may not be on the most solid financial footing. Ian heard this from a source. As a journalist, you hear a tip, and that's great, but the challenge is, well, then how do you prove that?
They confirm the tip with a leaked copy of Alameda's balance sheet.
What the document showed was that in a very powerful way, that there was a very strong financial entanglement between these two companies.
Their article goes live on November 2nd, exposing for the first time that nearly half of the $14.6 billion in assets on the balance sheet of Bankman-Fried's secretive crypto hedge fund were listed as FTT tokens, digital currency Bankman-Fried and his co-founders created for FTX customers back in 2019.
Sam, on the other hand, kept selling his story. He claimed he'd founded FTX to create a more sophisticated trading platform, one built for professionals rather than casual crypto investors. The idea caught fire. Soon, hedge funds and investment banks were lining up. Sam raised over $2 billion, including major investments from BlackRock and Sequoia Capital. How did he charm them? No one's quite sure. Sequoia even published a glowing profile of Sam, bragging that he was playing League of Legends during a $210 million investment call. And they loved him for it. One partner even typed in the group chat, "I love this founder." Hours later, they wired the money. They would never see it again. Behind the curtain, things were unraveling fast. According to CoinDesk, current and former employees described FTX and Alameda as a mess of favoritism, blurred roles, and zero oversight. 3 people, Sam Bankman-Fried, Gary Wang, and Nishad Singh, controlled almost everything: the exchange's code, its trading engine, and even its internal accounting. One insider admitted, if they changed numbers or moved funds around, I doubt anyone would notice. Nepotism ran deep. Nishad's girlfriend, Claire Weiberg, lived with Sam and was suddenly promoted to head of HR, giving her the power to fire anyone who challenged him. Employees later said Sam demanded total loyalty and was the ringleader of every risky decision. Most trusted him completely. They'd soon regret it. But at the time, the crypto world was on fire, in the best way. Prices were skyrocketing. New investors were flooding in, and FTX was minting money. By mid-2021, the platform handled $10 billion in trades per day across more than 1 million users. The company's name was everywhere. On UC Berkeley's football stadium, the Miami Heat's NBA arena, and even Formula One cars through a partnership with Mercedes. Big-name stars like Tom Brady, Stephen Curry, Naomi Osaka, and Larry David fronted its ads, all reportedly paid in FTX equity. According to NBC News, Brady himself had put hundreds of millions into the exchange. And yet, beneath all that fame, FTX had no real board of directors. Just Sam, one employee, and a lawyer signing off on decisions. The company was expanding into politics and global finance, even becoming a partner of the World Economic Forum and helping process crypto donations for Ukraine, converting them into fiat for the country's central bank. By then, Sam was everywhere. Panels, fundraisers, conferences, political galas. The $26 billion wonder boy who looked like he'd cracked the system. Only no one realized how thin the ice beneath him really was. By now, Sam Bankman-Fried wasn't just a crypto mogul, he was becoming a political powerhouse. In 2020 alone, he poured $5 million into Joe Biden's presidential campaign, instantly earning a seat among Washington's elite donors. 2 years later, as the 2022 midterms approached, Sam spent another $50 million, spreading contributions across both parties. But behind the headlines was a quieter player, Ryan Salame, one of FTX's top executives. While Sam funneled money toward Democrats, Salame directed $23 million to Republican candidates. A perfect two-pronged strategy. It wasn't about ideology, it was about influence. FTX was buying access to both sides of the aisle, and almost no one noticed. Then, in November 2022, something bigger began brewing. The Federal Reserve, alongside major banks like Citigroup and Wells Fargo, announced a pilot program to test a digital US dollar, a potential central bank digital currency.
After years of speculation, the concept was finally inching toward reality. And where did FTX want to position itself? Right at the center of America's next financial system. But while Sam's empire was growing, someone else was watching, very closely. Changpeng Zhao, better known as CZ, the CEO of Binance, and FTX's biggest rival, had been keeping tabs on Sam's moves. One tweet from CZ would soon trigger a chain reaction powerful enough to bring down the entire FTX empire.
All the FTT tokens in existence were sitting on the balance sheet of Alameda.
According to the criminal complaint, SBF engineered the price of FTT by directing Alameda to buy large amounts of the token to maintain its price. And that creates a huge problem. Alameda could not have sold its billions of dollars of FTT tokens without crashing its price.
Their presence there, there's such a substantial presence on that balance sheet, was a suggestion that perhaps this is a house of cards.
To make matters worse, Alameda began using it as collateral to obtain billions of dollars in loans from third-party lenders, leaving Alameda exposed to significant financial risks, according to the complaint. And by the summer of 2022, several of Alameda's major lenders go bankrupt after a $2 trillion crash in the crypto markets.
It was probably an opportunity for Sam to say, wow, I just got smoked out alongside of Terra Luna and Celsius and Three Arrows. I'm shutting down Alameda, and I'm going to focus all my energy on FTX. I think if he had done that, I don't think we'd be in this situation.
For Sam, the shift began quietly, in mid-2022. Inflation was spiking, and the Federal Reserve began aggressively raising interest rates. Higher rates made borrowing more expensive, investors more cautious, and speculative assets, like crypto, far less appealing. As the crypto market crashed, one company after another went bankrupt. That's when Sam stepped in, casting himself as the industry's white knight, bailing out struggling firms and buying their assets at record discounts. To the public, it looked like he was saving crypto. In reality, he was burning through cash he didn't have. Behind the scenes, Alameda Research was drowning in losses from bad trades and risky bailouts.
To help stabilize the ecosystem, that is Sam Bankman-Fried, founder and CEO of crypto exchange FTX. Bankman-Fried's company provided a loan made up of crypto and cash. It was worth about $500 million. Voyager only drew on about $75 million worth of that total. Legal analysts, though, are telling me it's unlikely Alameda will recoup that equity and credit line. That money may be wiped out in Voyager's restructuring.
Still, the media hailed him as a hero. On TV, analysts called Sam the stabilizer of the crypto ecosystem. They didn't know that much of his rescue capital came from FTX customer deposits. According to Reuters, Sam secretly transferred $4 billion in FTX customer funds to Alameda to keep it afloat, without telling investors or employees. Publicly, he brushed it off, tweeting, "Heads up, rotating a few FTX wallets today. Routine, won't have any effect." But it wasn't routine. Blockchain analysts noticed that this was the single largest token transfer in FTX's history, and the destination wallet didn't belong to FTX. It belonged to Alameda. Even worse, Sam didn't tell his top executives about the move, fearing it would leak.
Not long after, Caroline Ellison slipped up during a conference call, admitting that FTX had used customer money to cover Alameda's debts. Just like that, the 27-year-old CEO had confessed to what could become a criminal case with massive consequences. And here's where the foundation truly crumbled. Those billions funneled into Alameda weren't in US dollars. They were in FTT, FTX's own made-up token. That was the heart of the scam. Sam was essentially printing his own currency, assigning it an arbitrary value, and using it as collateral to borrow real assets. Imagine walking into a bank and asking for a $10 million loan, promising to repay it with monopoly money you designed yourself. That's what was happening on a global scale. As CoinDesk later revealed, Alameda's leaked balance sheet showed that out of $14.6 billion in assets, the majority was tied up in FTT tokens. In other words, Sam's empire was a house of cards built on a coin he'd invented and convinced everyone was valuable. It was only a matter of time before someone tried to knock it down. It was all starting to look very, very shady.
Instead, at the direction of Bankman-Fried, Alameda greatly increased its usage of FTX customer funds to meet its external debt obligations, according to the CFTC. FTX customers are completely in the dark about what's happening with their money. Their first indication there could be problems at FTX happens on November 6th, 4 days after the CoinDesk article reveals the billions of dollars worth of FTT tokens on Alameda's balance sheet. One of FTX's biggest investors gets spooked. The CEO of Binance, the world's largest cryptocurrency exchange, who goes by his initials CZ, makes an announcement in a tweet to his 7 million followers saying, "We have decided to liquidate any remaining FTT on our books."
And recently, with the news of them becoming insolvent, carried by CoinDesk first, we just said, well, we want to sell those tokens. That's all we did.
The single tweet from CZ is enough to make some customers panic.
A lot of market participants were getting spooked and were withdrawing the money.
We're seeing a run on the bank start, and that was leading to $4 billion a day of client withdrawals. At that point, we started calling prospective sources of financing because I was nervous.
But publicly, Bankman-Fried is telling customers a different story. On November 7th, he tweets, "A competitor is trying to go after us with false rumors. FTX is fine, assets are fine."
SBF came on Twitter and then he said a competitor is attacking us. We do not take client deposits and we don't invest them in anything, even treasuries. So I think that put my mind at rest that, okay, this is just fear on the part of market participants.
For Sam, that was never a problem, as long as his token, FTT, kept rising. But now, the crypto market was tanking. Prices across the board were crashing, and Alameda's balance sheet, filled with made-up assets, was quickly turning to dust. As liquidity dried up, whispers started spreading through the industry.
Was FTX really as stable as it claimed? It didn't take long for Sam's biggest rival to seize the moment. Changpeng Zhao, better known as CZ, had been keeping score for years. 6 months after FTX launched, Binance had invested about $100 million for a 20% stake in Sam's company. It was a friendly alliance, at first. But as FTX grew, Sam wanted total independence. He bought back that 20% stake from Binance for a jaw-dropping $2 billion, much of it paid in FTT tokens, his own currency. CZ accepted the deal, but he didn't forget it. Behind closed doors, Sam had also been lobbying US regulators to create a brokerage-style licensing system for crypto, a framework that would have forced decentralized exchanges like Binance into tighter restrictions. It was a move that could have crippled CZ's business. So when trouble finally came for FTX, CZ wasn't about to sit quietly. Around this same time, rumors of something even murkier began circulating. Reports surfaced that Gary Gensler, the head of the SEC, had previously worked at MIT alongside Glenn Ellison, Caroline Ellison's father. In fact, Ellison had once been Gensler's boss. Then came whispers of an alleged leaked email suggesting the SEC was considering giving FTX what's called no-action relief. Essentially, regulatory permission to keep operating despite violations. If true, it hinted at a troubling level of political favoritism, maybe even outright corruption. Meanwhile, CZ was sitting on roughly $2 billion worth of FTT tokens, and he knew exactly how fragile the system was. One wrong move could topple Sam's entire operation. So, he made it. On November 6, 2022, CZ sent a single tweet. Due to recent revelations, Binance will liquidate all remaining FTT on our books. That one post sent shockwaves through the crypto world.
So Binance CEO CZ got in on the actions. He said that he would be liquidating the exchange's FTT tokens on its books, and there was a little bit of back and forth with Alameda's CEO. Adam, I'm going to kick this off to you first. I was gone for a week, and what a story to come back to. Maybe you can talk us through what is going on.
Because FTT wasn't heavily traded, dumping that much at once would cause a free fall, and everyone knew it. Within hours, Sam jumped on Twitter to do damage control. A competitor is trying to attack us with rumors. FTTX is fine. Assets are fine. But nothing was fine. In just 72 hours, panicked investors yanked $6 billion out of FTX. Sam emailed employees, calling it a massive withdrawal surge, but insisting they were chugging along. Meanwhile, the value of FTT plunged 80% in 2 days. FTX's books were suddenly bare. The company had $9 billion in liabilities, but only $900 million in liquid assets. That's barely 10 cents on the dollar. Caroline Ellison tried to stop the bleeding. She offered to buy back Binance's FTT holdings to stabilize the price, but CZ wasn't having it. He fired back publicly. We won't support people who lobby against other industry players behind their backs. That was the nail in the coffin. As withdrawals spiraled and the exchange bled out, Sam made a desperate call to CZ, begging for help. The two agreed on a potential deal. Binance would acquire FTX outright. In a single day, Sam went from tweeting that everything was fine to selling his company to his biggest rival. CZ quickly announced the move, framing it as an act of rescue. FTX was in trouble. We stepped in to help. But everyone knew better. Dumping FTT had already destroyed FTX's valuation. Buying the remnants at a steep discount would have given Binance control over nearly the entire crypto exchange market.
Still, Binance wasn't exactly a saint in all this. The US Justice Department was already investigating the company for money laundering and sanctions violations, including allegations that it helped Iranian entities process $8 billion in trades since 2018. For a brief moment, it looked like one of the most ruthless business maneuvers in modern finance. A competitor crushed, then absorbed. But 2 days later, the story took another stunning turn. Binance abruptly walked away from the deal. After taking a closer look at FTX's internal books, CZ realized the hole was far deeper than anyone imagined. An $8 billion shortfall between assets and customer liabilities.
I did not think this was actually a cause of concern because I had all that faith and trust in the system. I'd already built that up over time.
But the very next day, Bankman-Fried deletes that tweet, according to the SEC. The price of FTT drops more than 75%, and it's now apparent that Sam's empire is crumbling. And investors like Anthony Scaramucci are concerned.
I went to the Bahamas on November the 8th. I flew down there. Sam seemed sort of disassociated, like the scene in Private Ryan where, the battle's happening and somebody loses his arm and they're actually holding their own arm in their hands. He was having a hard time processing that all of this was happening to him as quickly as it was happening. I left the Bahamas saying, okay, there's a huge problem here.
In a last-ditch effort to save the company, Bankman-Fried makes a surprising move, calling the CEO of Binance with an offer to sell them FTX. But the deal never gets off the ground. Patrick Hillman, Binance's chief strategy officer at the time, got a first-hand look at FTX's finances as part of its due diligence team.
It was like a bomb went off in that place. We're getting on calls, people are crying, even though we were within the first 12 hours of this crisis for them. So it was complete pandemonium over there.
What did Binance end up finding in the due diligence process?
We weren't able to do due diligence for that long. You asked for specific information, figures. The most basic figure is how much cash do you have in reserves? What are your liabilities, right? How much do you owe versus what you have today? And we couldn't make heads or tails of it.
The potential deal with Binance falls apart in less than 48 hours.
I'm thinking to myself, Binance pulled out. This is something very serious.
When CZ and Binance basically said, we're not doing the deal, that's when I was like, uh-oh, now I got to do whatever I can do to get whatever I got left. This was probably one of the most scariest times ever.
And for many customers, it's too late to withdraw their funds.
I requested all withdrawals of all my assets, but none of them completed. None of the withdrawals ever came through.
You're just helpless. What do I do? I was just in so much shock that could happen.
I had a huge amount of money, obviously, on the exchange. And I thought, okay, there's something wrong. Why would he stop withdrawals? Because in exchanges, if everyone takes the money out, all that's what should be left is the exchange assets. I thought this seriously wrong. I felt really sick.
It's clear FTX and Alameda cannot survive. And on the morning of November 9th, around 10 a.m. at an all-hands meeting, Caroline Ellison, the CEO of Alameda, tells staff earlier that year, in response to an accounting or bookkeeping problem, Bankman-Fried and other individuals decided to use FTX customer funds for Alameda. According to the CFTC's complaint, FTX and Alameda filed for bankruptcy 2 days later.
FTX wasn't just in trouble, it was already dead. With the news of Binance pulling out, even FTX's own employees were stunned. Many executives had no idea how bad things really were. The inner circle, the so-called kids in the Bahamas, had been playing with billions in customer money like it was a game. And now, they were losing. Badly. Soon, the US Justice Department began digging in. The investigation centered on $10 billion in FTX customer deposits that had quietly been funneled into Alameda Research. That was money FTX users thought was safely stored, not loaned out for risky trades. With no liquidity and no plan B, FTX froze withdrawals. Panic swept through the industry. Rumors of bankruptcy filled Twitter. Then, on November 11th, Sam Bankman-Fried resigned. In the same breath, he tweeted that FTX, FTX US, and Alameda Research were all filing for bankruptcy. The fallout was instant and catastrophic. In just 3 days, the world's 15 largest cryptocurrencies lost over $150 billion in market value. No corner of the crypto ecosystem was left untouched. What followed was chaos. FTX wasn't just one company. It was a web of 130-plus entities spread across the globe, all collapsing in real time. Traders, investors, and institutions were scrambling to recover whatever they could.
Sam issued an apology, taking full responsibility. But for millions of customers who lost everything, those words meant nothing. Just months earlier, FTX had been valued at $32 billion,
with backing from giants like SoftBank and BlackRock. Now, it was worth zero. And the story somehow got even darker. Investigators soon discovered that $1 billion worth of customer crypto had vanished. Reuters later reported that between $1 to $2 billion of customer funds sent to Alameda were simply missing. No one could explain where they went. Then came the hack. Within hours of the bankruptcy filing, over $500 million was drained from FTX wallets. Customers logged in to see their balances wiped to zero. Blockchain trackers watched in real time as the hacker moved the stolen coins into Ethereum, instantly becoming one of the largest ETH holders in the world. It was chaos, and everyone was watching. The damage rippled outward. Sequoia Capital, one of FTX's most prominent backers, wrote off its entire investment. The firm even mocked itself, noting that maybe next time they shouldn't invest hundreds of millions into someone playing League of Legends during a pitch meeting. Galwa Capital, the hedge fund that famously predicted Luna's collapse, admitted that half its capital was trapped inside FTX. BlockFi halted withdrawals and soon filed for bankruptcy. Even a Canadian teachers' pension fund had invested nearly $100 million, meaning everyday educators could now see their retirement savings take a hit. The scope was staggering. Bankruptcy filings revealed 134 affiliate companies, with total liabilities estimated up to $50 billion, more than double that of Enron.
But FTX customers who watched aren't buying it.
I have no respect for the person at this point, like zero. And anything that that person says is invalidated, in my opinion.
I think that's just bullshit and media narrative. Like, he's trying to frame the media narrative to benefit him. So that part really pisses me off.
I could see, literally, I knew that he was lying. He thought he could spin this story.
Less than 2 weeks later, as the sun sets in Nassau, on December 12th, the Royal Bahamas Police arrive at Albany. Police pull the former billionaire from the comfort of his penthouse and lock him up in this Bahamian prison. It's a hellish week for the former crypto titan, who follows a strict vegan diet. He reportedly survived on peanut butter and stale Wonder Bread. But for those impacted the most, Bankman-Fried's arrest still doesn't feel like justice.
SBF going to prison doesn't help me. I'm not getting up and popping bottles of champagne in the morning and having mimosas with my dog over SBF getting arrested right then and there. I still feel battered and bruised and completely demoralized.
And fittingly, FTX's new CEO was none other than John J. Ray III, the same lawyer who oversaw Enron's liquidation. The White House issued a brief statement calling for tighter crypto regulation. As for Sam, his empire was gone. His net worth had plunged from $16 billion to negative. Reports indicated he was under police surveillance in the Bahamas, as both U.S. and Bahamian authorities coordinated investigations. On November 16th, Sam tweeted that he was meeting regulators to make customers whole. The replies were brutal. You should be in jail. Stop tweeting. Start talking to the FBI. Meanwhile, Bloomberg reported that U.S. officials were in talks with Bahamian authorities to extradite Sam to the United States for questioning, a process that would test just how far his political donations could carry him. And then came the rumor that still haunts the case. The so-called hack might not have been a hack at all. Some insiders claimed it was an inside job, that the stolen funds were drained through a hidden backdoor Sam had coded himself, allowing him to move assets without triggering alerts. When Reuters asked him about the missing billions, Sam's response was chillingly simple. Question mark? The entire crypto landscape was left shaken. No one knew who could be trusted, or which companies might be next. Billions were gone, faith were shattered, and regulation, once a distant idea, was now inevitable. As of now, the questions remain. Where did the missing money go?
On the evening of December 21st, a convoy of SUVs transporting Sam Bankman-Fried arrives at a private jet hangar in Nassau. And as soon as the private jet is in the air, flying Bankman-Fried to New York to face criminal charges, the Department of Justice holds an unexpected press conference.
The Southern District of New York has filed charges against Caroline Ellison, the former CEO of Alameda Research, and Gary Wang, a co-founder of FTX. Both Ms. Ellison and Mr. Wang have pled guilty to those charges, and they are both cooperating.
Gary Wang, the 29-year-old mysterious co-founder of FTX, flipped on Bankman-Fried. In court testimony, Wang said, "I was directed to and agreed to make certain changes to the platform's code. I executed those changes, which I knew would give Alameda Research special privileges on the FTX platform." The coding guru testifies he knew what he was doing was illegal.
Gary was someone who was very difficult to get to talk. At FTX, when I would go and occasionally try to visit the office in Bahamas, Gary was someone who never spoke to anyone. He would show up at 5 p.m. and leave at 4 a.m.
27-year-old Nishad Singh, FTX's director of engineering, also pleads guilty to fraud charges. Brett Harrison says he raised concerns about Gary and Nishad in a letter to Bankman-Fried just before he left the company.
Gary Wang, the CTO of both FTX and FTX US, and Nishad Singh, the director of engineering of both FTX and FTX US, had written 90+% of all the code for the exchanges. And they did very little, I thought, to really disseminate the knowledge, such that if either one of them suddenly, ended up in the hospital and couldn't come to work anymore, I think the exchange would have been done. It would have been over, because all of the knowledge was in those two guys' heads.
Caroline Ellison, the 28-year-old CEO of Alameda Research, also shares what she knows, telling the court, "I understood that FTX would need to use customer funds to finance its loans to Alameda, and that most FTX customers did not expect that FTX would lend out their digital asset holdings and fiat currency deposits."
We don't really do any technical analysis.
In this bizarre interview with the El Momento podcast, less than 6 months before Alameda's meltdown, Ellison makes some surprising admissions about running the crypto hedge fund.
We use very little math. We use a lot of elementary school math. We tend not to have things like stop losses.
Later, Ryan Salem, the former head of FTX Digital Markets, pled guilty to 2 criminal counts related to the FTX case. Guilty pleas from SBF's top lieutenants gives investigators valuable information for their case against him.
Who was behind the hack? And how deep does this web of deception really run? FTX created its own token, FTT. And here's where the trick begins. If you're trading your own token on your own exchange with wash trading and leverage, you can make that token worth whatever you want. Want to create $1 billion? Just push the price up by $3. Instantly, you've made $1 billion in collateral, out of thin air. Now, in a sane world, no bank would ever lend against something that fake. But Sam didn't need a bank. He was the bank. He loaned money to himself. Then he took real assets, Bitcoin and other crypto, from honest customers. He rehypothecated them, traded them, and lost them. It's one of the most blatant ethical failures the financial world has seen in years. And the scary part is, it all went on for so long. So what do we learn from this? If you're an investor, only put in what you can afford to lose. Because in a bull market, when money is cheap and hype is high, even the smartest people start losing their grip on reality. They'll hand hundreds of millions to a 30-year-old and his circle of friends in a Bahamas penthouse. People with barely any experience, because the dream of making millions is just too intoxicating. When you step back, the entire saga feels like nobody knew what they were doing. And maybe, just maybe, something deeper was happening behind the scenes. A web of political lobbying and influence that blurred the line between power and corruption.
When it comes to Chapter 11 bankruptcy, especially when it comes to exchanges and things like that, the chances of you getting even some or most of your money back is very low.
For now, only FTX customers in Japan have been able to withdraw any of their funds due to strict crypto regulations in the country. The company says its Japanese customers have been able to withdraw 6.6 billion yen, which is nearly $50 million. For other customers, it could take much longer to get any of their money back.
I knew in 1 second that as soon as the bankruptcy was finalized and declared that I'm not getting access to any of this money for the next few years.
I've resigned to the fact that I will not get all of it back. It will be a miracle, I think, if all of the money is found wherever it may be hidden or not hidden.
And while the bankruptcy process is ongoing, the value of those assets in a volatile crypto market could go up or down.
I'm generally an optimist, so hopefully we can see some money back.
But Sunil Kavuri is hedging his bets, joining a lawsuit with some other FTX customers, suing FTX's celebrity endorsers in an effort to recover some of their losses.
We can't say for sure, but it's concerning. It all feels hauntingly familiar. Because this isn't just a crypto story. It's the same pattern we saw in 2008. Firms inventing financial products, over-leveraging, and passing the risk to everyone else. Ironically, crypto was supposed to end that cycle. Instead, it became a mirror of the very system it promised to replace. Because where there's money to be made, there will always be bad actors. Anyway, that's it from me. Thanks for watching, stay curious, and I'll see you in the next episode.